Hi, good morning. Um, this is Prateek this side, and we will be starting with US taxation. So, this course is basically designed to create a fundamental knowledge about how we can learn about accounting, and then accordingly, how can we create and learn US taxation. And what do I mean by US taxation? Corporate income taxation. Myself, Pratik Bora, I've been doing US taxation for the past 6 years. I worked in Big Fours before. I am currently working in Big Fours as well. So there I've utilized my expertise in order to file various corporate income tax, both federal and state returns. So today I'll be uh, going forward with this one, and the main goal of this coaching is to create an understanding as to what do we do about, how do we understand US taxation. And secondly, as an industry, this is quite a lucrative industry, so it's anybody that wants to get into US taxation can refer to this one. And this will act as a comprehensive guide as to how to get from basic novice of commerce who has done accounting but have not done that much of an accounting, and probably do not understand how things interrelate, and how do we get from general entries, from transactions to general entries, to your ledger posting, then to your trial balance, creation of trial balance, then coming to uh, once the trial balance is created, then coming to preparation of profit and loss account and balance sheet. And through that effort, all we are trying to achieve is how do we get from the accounting income, which is also called as the book income, and from that, how do we arrive at tax income on which we file income tax return and we pay taxes on that taxable income. So that's what is one of the things that we'd like to understand. Now, what we are going to be deciding is, so today it's just going to be an introduction between how it flows, how the flow happens from accounting to taxation. So accounting and taxation, if you see, so let me see this one. Accounting and taxation are interlinked but serve different purposes. So accounting is done for transparency purposes, whereas taxation is done for compliance purposes. Accounting focuses on fair presentation and picture of the financial health. Taxation, on the other hand, align financials with rules mandated by IRS and state laws. So accounting is accounting standard. So you might have heard of something called an accounting standard. If you've not heard, that's fine. What happens is there are globally accepted principles on which accounting works, and US taxation is governed by IRC rules, which are latestly, I think, implemented in 1986. So from then we go with the taxation rules. Accounting is done so that we can arrive at a transparent picture of what is the financial health of the company, whereas taxation is done in order to create a tax in order to arrive at a taxable income through which we can complete our compliance part towards the government or any IRS department. Now this course will take you to step by step from raw material, like whatever we get. So for example, we might get transactions through which we might have to create something else, but so what we'll do is, we'll also give you a basic understanding of how the accounting will work and how that will get transformed into something called a PBC. PBC is something that whoever is your client will provide you a trial balance account, and through that trial balance account you'll have to, so if you are working in tax, generally the first source of document that we get is trial balance, and through that we go and get into much more detail. We code it, we classify it into P&L and balance sheet. Accordingly, we calculate whatever is your book income, and then we have your respective adjustments. But that's something that we will discuss on a later point. Now, how does the book income converts into taxable income? That is because the taxable income does not so there's something called tax adjustments. So there can be cases where the book income includes certain deductions, which at the book level it is fine to claim it, but IRC might have different rules for it. IRS might have different rules for it. For example, case in point is depreciation. So for example, if depreciation in the books, we might charge, let's say we have a machinery, we purchase it for $100 and we are taking a straight line deduction for 5 years on that machinery. It is possible that we might take just $20 as an adjustment for per year. But when it comes to tax, what's going to happen is the IRC rules are going to apply, and accordingly the rates might change, the method of calculating of depreciation might change. So these are some of the ways, and so the difference between your book treatment versus your tax treatment, that's something that is called a tax adjustment. So that's what we will be doing this. Now you learn what each document is and why it matters and how it's used. This foundation is vital for anyone working in corporate tax and compliance. Yep. Let's begin by understanding what makes accounting and taxation different. So now now that I already explained that book and tax, there's a big difference. So book, whenever we will refer book, we will mean accounting from the point of view of accounting. But when we mean tax, we will mean from the standard point of view of taxation. Now, objectives. So accounting, as I mentioned, aims at transparency. It allows the business to understand whether they are actually making profits or loss at the end of the year, utilizing their own the principles in order to record the transactions and come to the point where it is necessary. But whereas taxation does not have anything to do with the fair transparency purpose, it's used for compliance. So government and IRS will require you to file the tax returns with them, and they will collect taxes accordingly. So that's why taxation is important. Accounting follows US GAAP, whereas taxation will follow IRC code. So there's an internal revenue code that is published by IRS department, and over the years it's not like a singular income tax act or anything like that. It's codes that have been over the years have been amended and activated, so that is called the IRC code. Accounting focuses on business economics, whereas tax focuses on legal obligations. So business economics, so that's one thing. So business economics here, what they mean is, so accounting will accurately try to determine and classify the P&L and balance sheet items accordingly as per the business requirements, and they will come to the as per their understanding and their and globally recognized principles as per US GAAP. They will understand what are the actual economics of the business, whether they are actually making money or they're making loss, what's the situation that has happened over the year. That's one thing that accounting helps you to do. Now, revenue and expenses may differ under law versus accounting rules. So for example, there may be expenses such as meals. Let's take an example as meals. So what happens is, at the book level, whatever amount that you paid in order to conduct business, including meals, is 100% allowed. But when it comes to tax, one of the common tax adjustment that you're gonna always find is that meals, it's gonna be 50% allowed. 50% as per the IRS rules, it says it's disallowed, so therefore it is disallowed. That's something that's one of the adjustments. So if you see with this example, you can understand that some expenses can be allowed in books but may not be allowed for tax. So in case of conservative principle, accounting may delay income recognition, tax may accelerate. So accounting might say that, okay, the income is, it's not yet received, but and we have not even conducted any activity, therefore we will recognize when it comes, which is more suited to the US GAAP principles. But tax might say that, okay, using the conservative approach, if it is reasonably if it is reasonably identified that, okay, we will receive this income in future, then you can recognize that in the current year. So that's one of the main differences between your accounting and taxation. Now, consistency. Book reporting should follow consistent methods. Tax allowed certain elections. So there are certain tax elections that we can make, and book reporting, generally what you do is, if you selected accrued book of accounting, that means you are following this accrual method. So it's gonna be same every year. If you've taken, for example, if you're taking depreciation and you are following straight line method, any asset that you are purchasing, you will generally use consistency principle, and will depreciate the assets over time in a straight line method. Whereas in case of tax, what you can do is you can decide either to opt in for bonus depreciation or opt out of bonus depreciation. Now, bonus depreciation is a concept that we will discuss in the future, but for now you can understand that any deduction which is taken extra due to the regulations provided by IRS is something that we utilize, and it is something that is called as bonus depreciation. There are certain rules and regulations regarding that. We will discuss that in the future, but for now you can understand that more whatever extra depreciation that we are allowing based on IRS documents, US, the taxation might allow the elections for them every year. So we can opt out of that method, or we can opt in of that method based on the respective requirements there are. So tax allows certain maneuverability. Now, understanding how to avoid mistakes in book to tax income. Coming to the third slide. So what is the, now that we come to the taxation part, taxation starts not at the PVC level, but it starts with the accounting level. So first you have to, if you understand accounting, then only you will be able to understand how the taxation will be treated. So in order to understand the entire accounting cycle, what you have to understand is there will be certain transactions that might occur during the year, during the course of the business. So during the course of the business, you will be vouching the transactions. What are those what is vouching? Vouching is basically recording the transactions into debits and credits at whatever has happening. Then those vouchers will then be considered. So the bill of the transaction is called voucher. So that voucher gets converted into journal entries. Journal entries are the fundamental entries of debits and credits that happen in order to record any transaction. There are certain rules that we will come to on and we will get into that. Now, once those general entries are recorded, then at the end of the year, what we are going to do is those general entries will automatically be immediately posted to general ledger accounts. General ledger accounts are basically the heads of accounts in which the transactions are recorded. For example, if meals, for example, let's take meals as an example. You might have went to 100 restaurants and you might have ate during the year in 100 of those restaurants. Let's say the restaurant A is 1, 2, 3, 4 and so on. Now, according to the restaurant, you might have went there 200 times. You might have went into 200 times. But in general ledger, what you will see is all those 200 transactions will be recorded into that general ledger, and whatever is the ending balance of the general ledger will get posted into your trial balance. General ledger is a ledger where all your general entries will be recorded. As general entry is a two-sided entry, there will be a debit side and there will be a credit side. So every general entry is gonna impact two general ledgers at the same time. So once you record all the general ledgers, what's gonna happen is whatever is your ending balance of that general ledger, that will get posted to your trial balance. Trial balance is nothing but the ending balances of all the general ledgers which have any activity made during the year or any other activity that is made during the year. General ledger also can have beginning balances. For example, when we talk about balance sheet items, for example, cash, it is possible that during the year there have been no transactions made, but that doesn't mean at the end of the year the balance is zero. That's because general ledger, how it works is, you will have your beginning balance for balance sheet items, then you will have transactions, and at the end you will get to your ending balance. That's how general ledger for balance sheet item works. But in case of P&L items, profit and loss items, they are generally for the particular year. They will not have any opening or closing balance. Now, once the general ledger is being created, and it gets posted to trial balance. Once the trial balance is created, then this is the main source of document that you have received for the calculation of your book income and further any other updates. Now, once you have received that trial balance, you must understand that what is a trial balance. Trial balance is all the accounts from general ledger being posted into ending balances of the general ledger posted into a statement. Now, the total of trial balance always will be zero. And why is that? That's because, as I mentioned before, general entries are two-sided entries. One is going to be debit, another one is going to be credit. There's something called debit and three rules of accounting that we will discuss. But understand this point for now, that every general entry is going to have two sides. One is going to either increase it, or other side might be in order to increase or decrease it. So when all those general ledgers in which both sides have been updated, when we post that into the trial balance, the net balance of the trial balance will always remain zero. Why is that? Because trial balance consists of both P&L and balance sheet, and at the end of the year, when we talk about the P&L plus balance sheet, the net result always remains zero. And how does that happen is, assets plus liabilities plus shareholder equity always comes to zero. Now, from the trial balance, we can classify the accounts into P&L and we can classify the accounts to balance sheet. Profit and loss statement is called P&L. Profit and loss statement is made for the particular period. For example, at the top of the profit and loss statement, it is always written that for the period ending on from 1st January 2025 to 31st December 2025. Now, for that 1 year, we are preparing a profit and loss statement. Whereas, whenever you see balance sheet is always going to be as on. So balance sheet is created on a particular date, whereas P&L statement is created for a particular time frame. That's the main difference between P&L and balance sheet. P&L is calculated in order to identify what is the taxable income or loss for the year, whereas balance sheet is whatever has been done till date in future, till date for the business, including all the past performance. So that's the difference between balance sheet at a given date. So that's the difference between P&L and balance sheet. Now, P&L, so if you see, P&L summarizes income and expenses, balance sheet shows assets and liabilities. Now, what's an income expense? I hope you are able to understand what's income expense and then assets and liabilities. These two are pillars of financial reporting. Based on this one, entire taxation works, entire finance works, entire accounting works. They form book income, starting point for the tax work. So what's book income? As I mentioned before, book income is the starting point from which we will get from your trial balance. Once we have classified that into P&L and balance sheet, you will arrive at your book income as per accounts. Now from that, you will have certain adjustments, you're going to make some updates, and then you're going to arrive at your taxable income. But at the end of this process of accounting cycle, you will arrive at your book income, that is income or loss, of course. So that's the one thing that you will like to arrive at. Now this is about the accounting process. Now coming to the three rules of accounting. So there are three major fundamental rules that are globally followed in accounting, and those three rules are: debit what comes in, credit what goes out. You can rhyme with me. This is the golden rule. Debit what comes in, credit what goes out. That is used for real accounts. Then there is debit all debit all expenses and losses, and credit all the income and gains. And this is for nominal accounts. And similar to that, you have personal account, which says debit the receiver, credit the giver. Okay, so these are the three fundamental things that every person learns when accounting is taken as a subject, and based on that only will be passing your journal entries. So as I said before, the journal entries are two-sided entries that we will be passing. So those two sides, right, one is going to be debit, another one is going to be credit, and what's going to be debited, what's going to be credited is determined by the three rules which we have discussed. So if I go with this one, real accounts relate to assets and liabilities, things that business owns or it owes. There are accounts are permanent and not closed at the end of the accounting period. So cash, for example, or let's take building, computer, whatever it is, any asset, land. So just because the year have ended doesn't mean it's not going to be there in the next year, right? So that's why it's a real account. So examples could be, if you see, cash account, furniture, building, bank loan, inventory. So purchase. So what's going to be the general entry of, let's say you bought furniture, you bought it from cash. So what's going to be the entry? So you can go with the golden rule. What does it say? Debit what comes in, credit what goes out, right? So now what is coming into the business? Furniture is coming into the business, and what is going out of the business? We are buying it with cash, right? So furniture will be debited and cash will be credited. So that's what the entry is. Furniture account debit 10,000 to what is going out, credit to cash account. It is possible that we might buy into, we might buy it on credit, and then instead of to cash account, we might have account debtors into it, account creditors into it. So we might have bought it on credit, so it's going to be like to a creditor account. Coming to the second point, nominal account. Nominal accounts relate to income, gains, expenses, and losses. These accounts are temporary and are closed at the end of each accounting year by transferring to the P&L loss account. So what's the golden rule for nominal account is debit all expenses and losses, credit all income and gains. So for example, you paid salary account. Okay, so what you do is salary is an expense. If you are paying a salary needs to be what? It needs to be debited. And for example, who are you, like if you are paying it on, let's say you are paying it in cash. So, and it's not like nominal accounts, real account, and personal account is gonna work independently. They are gonna work interdependently. So for example, you hired a person and you are gonna pay a salary of 10,000 rupees. So salary account is a nominal account. So we have to pay it. It's an expense. So what we are gonna do? We're gonna do it debit. So salary account debit will be 10,000, and what we are paying? Are we paying cash or bank, or are we just crediting it? So if we are doing a cash payment of the salary, cash is what? Cash is a real account. So real account, what's happening to cash? Cash nature is debit, but it is going out. So what we are going to do? We are going to credit that, right? Because that's going to decrease the amount, decrease the cash balance. So from that, you're going to arrive from, so what's going to happen is you're going to pay the salary. So the entry is going to be salary account debit to cash. That's the entry that's going to be there. Now coming to the third point, some of the items that will be covered in the third point is debtors and creditors. So personal account relates to individuals, companies, or organizations. There can be natural person, artificial person, or representative person. The main rule for this is debit the receiver, credit the giver. Now, for example, you are saying that I have to pay Rajesh, which is my creditor, which is my debtor, an amount of 20,000. So debit the receiver, credit the giver. So we are going to pay Rajesh 20,000 rupees. So 20,000 is being paid from which account? Cash account. Cash account is a real account. So now that if we are paying cash, right, what's gonna happen? We are gonna do Rajesh account debit to cash. Why? Because the cash is a debit account, but we are paying it. So what's gonna happen with that is debit what comes in, credit what goes out, right? So what's going out? Cash is going out, so we're gonna credit that, and debit the receiver. So who are we paying it to? We are paying it to Rajesh. So what you're seeing is here is a different entry. That's when you, instead of paying Rajesh, you are receiving from Rajesh. So what's going to happen is, instead of paying anything, you are receiving cash. So when we are receiving something, debit what comes in. So it's going to be cash account debit to Raj's account. So that's how it works. So just to summarize, real account is basically for assets and liability. The rule is debit what comes in, credit what goes out. Examples are cash, machinery, furniture. They do not get over at the end of the year. What are nominal accounts? Expenses, losses, income, gain. Those are your nominal accounts. And what is the rule for that is debit all the expenses and losses and credit all the income and gains. Now, what are some of the examples that you can do is anything related to P&L. For example, rent, salary, commission, interest. These are all expenses. So they they can be, they will be debited. It is possible that we might have rental income. In that case, it will become credit, right? Now, the third one is summarizing. Personal is for person or entity. So it can be a singular person or it can be an entity, artificial person, anything. Now the rule here is debit the receiver and credit the giver. So for example, Raj's account, outstanding wages, these are, so this is mainly for your debtors and creditors, that's all. So these are the three rules that you must understand before you get on with any kind of accounting work. These three rules are prima facie the most important on which the foundation will be built. So it's like you have to understand and you have to memorize these three things, that what are the three types of accounts: real account, nominal, personal, and what are the rules for that. Debit what comes in, credit what goes out. Debit all the expenses and losses, credit all the income and gains. Debit the receiver, credit the giver. These three are the most fundamental principles on which accounting will function. So these are some of the things that we've discussed. So these are the types of accounts that we've discussed. And in order to summarize, what we are trying to do is we are trying to learn. So what we learned today is what's the difference between accounting and taxation. How do we get from, what are the key differences between accounting and taxation? What are the rules they follow? What are the things that they are used for? Who uses them? And what is the process of accounting? We have started with the process of accounting today. From transactions, how would you arrive? So you will have your transactions, then you're gonna pass journal entries. Those journal entries will get posted to general ledger. General ledger will then get posted to trial balance. Based on the trial balance, you will classify that between P&L and a balance sheet, and from that P&L balance sheet, from P&L you will arrive at book income. Book income will be the first thing that we will utilize when we will be starting with the process of getting and calculating our taxable income. We've learned this is the process that we are going to follow, and we've also learned about the three accounting principles on which we will be working, and based on that the journal entries will be passed. Next session we are going to discuss how the journal entries will get passed, what are journal entries, how would you pass it, what does general ledger look like, what does P&L looks like, what does balance sheet looks like, what does trial balance look like. So the entire accounting process is going to be covered in the next session. So let me know if you have any other questions, but this is it for today. Thank you.